In 1936, most six-year-olds in Omaha, Nebraska, spent their afternoons playing baseball. Warren Buffett had a different hobby. He was obsessed with a single, highly unusual question for a child. How could he make a little more money today than he did yesterday? He started by walking into his grandfather's grocery store and buying a six-pack of Coca-Cola. Instead of drinking it, he walked door to door, selling each bottle separately for a few cents profit. Those few cents triggered an idea. He realized that money wasn't meant to be spent on toys. Every dollar was an employee, and if a dollar wasn't making another dollar, it was being lazy. Look at this equation showing his core strategy. Profit plus reinvestment equals growth. He refused to spend his earnings. He took those early profits and bought chewing gum to sell, then golf balls, then used stamps. He constantly funded new micro-businesses. By age 6, he had already established the habit of putting his earnings back into the cycle, allowing his small pool of capital to expand through constant redeployment. By age 13, Buffett secured one of the hardest paper routes in town. Every morning before sunrise, he delivered hundreds of newspapers, completely ignoring the rain, snow, or heat. While other teenagers spent their allowances, he tracked every penny he earned. He kept meticulous records, calculated his exact profits, and invested the cash right back into his system. By the end of that year, he had amassed thousands of dollars in pure savings. Amassing that kind of capital as a teenager in the 1940s required a near-obsessive ability to delay gratification. Delivering papers had a strict physical limit. No matter how hard he worked, there were only 24 hours in a day. To scale his wealth, he had to break the connection between his time and his income. At 14 years old, he took $1,200 of his savings and bought an asset adults rarely considered, a 40-acre plot of farmland. He didn't work the land himself. He rented it to a tenant farmer. The physical labor happened entirely independently of his own effort. This graph illustrates what happens when you separate time from earnings. The hours worked flatlines, but the income continues ticking upward. This is passive income, money arriving in your pocket even while you sleep. By introducing passive income into his strategy, wealth creation stopped being a manual task and became a highly scalable, automated system. Seeking a more rigorous intellectual framework for investing, Buffett applied to study at Columbia University. He wanted a logical, calculated method. The traditional Wall Street trading floor was chaotic, driven by raw emotion, noise, and short-term speculation. At Columbia, he found a mentor in Benjamin Graham, the author of The Intelligent Investor. Graham taught his students that patience, not excitement, makes money. This chart demonstrates Graham's core philosophy. The jagged line is the market price, bouncing wildly. The thick, straight line is its intrinsic value. Stocks are pieces of real businesses, holding an actual underlying worth, regardless of daily market noise. Investing mastery requires the emotional discipline to wait calmly until that chaotic market price drops below the company's true value, and only then buying in. In the early 1960s, Buffett applied this logic to a struggling textile company called Berkshire Hathaway. The business itself was failing, but the stock looked cheap on paper, prompting a controlling stake. He later admitted that buying Berkshire was a mistake. The textile industry continued to collapse, forcing him to adapt his strategy. Instead of pouring capital into a dying factory, he took its remaining cash flow and stopped buying random cheap stocks. He redirected the money entirely toward acquiring highly profitable businesses. He targeted companies with fiercely loyal customers and strong brands. American Express fit this profile perfectly, generating consistent profits year after year. This completed his formula. He used passive cash flow to acquire high-quality businesses at fair prices, creating an endless cycle where money constantly generates more money. Buffett's favorite way to explain his financial empire relies on a simple image, making a tiny snowball and rolling it down a long slope. The snowball represents compound interest. Small, consistent gains, repeated continuously, accumulate into massive fortunes over time. Look at his net worth over time. It stays relatively flat for decades, then curves exponentially upward right here, at the age 50 marker. More than 99% of his multi-billion-dollar fortune was accumulated in the second half of his life. Buffett was skilled at identifying businesses, But the sheer scale of his fortune is largely a product of staying invested for 8 decades without interruption. Time does the heavy lifting. Without decades to let the math work, the formula cannot reach its true potential. Today, despite being one of the richest people on Earth, Buffett still lives in the same modest Omaha house he bought in 1958. His steady path to billions required completely rejecting the flashy, high-speed gambling that society often associates with Wall Street. The process of building wealth is highly disciplined, but straightforward. Make your first profit. Save instead of spending. Buy quality assets, and let time compound the results. You do not need to start with millions of dollars to build lasting wealth. You just need to start building your snowball today.